Hey Bowtie Nation, Joseph Hogue here. Thank you for joining us for another Monday market update, 9 a.m. every Monday morning. Get you ready for the week, stocks to watch, economic news to follow, and the stock market just closed its best month in more than 2 years, with the S&P 500 up 11.5% from that pullback in October. Nearly 10% of that in November alone. Not all stocks are enjoying that. We're in further into a bull market though. Shares of electric vehicles and related stocks are down for the year, even as the broader market approaches an 18% return for 2023. The Crane Shares Electric Vehicle and Future Mobility ETF, ticker KARS, rallied just 4% in November and is still down 15% on the year. Are EV stocks out of gas, or can they drive prices higher? I'll talk about that in the main topic. Stick around after that. We'll do our Monday market update, stocks to watch, and the economic news you need to see. But first, all you out there in the Bowtie Nation know, real estate will always be a special place in my portfolio. The problem has always been, though, directly owning rental properties is a pain, and this year commercial real estate is in chaos. That's why recently I shared my new favorite way to invest in real estate, Arrived Homes. With the platform, you get direct ownership of single-family rentals, the only profitable side of real estate market right now. You can invest as little as $100 and get a fractional ownership of a rental property. Arrived manages the properties, distributes rental income to investors every 3 months, and then pays out the price returns when the properties are sold. Return on individual properties has been really good, as high as 136% over the 5-year period, and dividends from 3 to 8% make it a solid cash flow investment. Now though, Arrived is also launching a fund of properties, the Arrived Single Family Residential Fund. The fund is designed to make investing even easier with a constant stream of new properties and diversification across locations. Arrived has plans to convert it into a REIT in the future, but you can invest now through the platform. But I still like to invest in those individual properties on the platform for that feeling of direct ownership in a rental property and the fun of analysis in each. This new fund has me interested though. With more than 1.8 million in net assets just in the last week, it's becoming very popular with site investors as well. So I wanted to give you the heads up and see what you think. Click through the link I'll leave to Arrived Homes in the description below. Check that out. Let me know what you prefer, investing in directly in those single family rentals or through this fund. Back to our main topic though, and it never ceases to amaze me how quickly a theme can fall out of favor with investors. For years now, electric vehicles have been the growth story in the market. Shares of Tesla have made millionaires, with the stock jumping 15-fold just since the pandemic. Shares of Vietnamese EV maker VinFast Auto, ticker VFS, surged 466% in less than 2 weeks following its U.S. stock IPO this year. But just like Kaiser Soze, Blink and the returns on EV-related stocks have vanished. VinFast has lost 90% of its value and is trading below the IPO price. Charging leader ChargePoint Holdings is down 78% this year, and even mighty Tesla, even after a spectacular 145% surge in the first half of the year, is still no higher than it was 3 years ago. But are EV stocks really out of gas? Even on the current beating in these stock prices, most governments around the world have some kind of timeline to phase out gasoline engines. We see here a map of some of those phase-outs. That phase-out in sales of new internal combustion engines begins by 2030 for much of Europe. They're saying that they don't want any more new sales of combustion engines past that point, along with Los Angeles and Seattle there in 2030, here in the US, and then kicks into overdrive across the rest of the states by 2050. And even if those prior estimates for EV growth are overstated, here we see prior estimates for number of cars sold, as well as the percentage of EV cars as percentage of overall cars, with sales expected to reach 4.7 million cars sold annually in 2030 versus just 1.1 million this year. Even if those estimates come way down to like 3.5 million sold in 2030, it would still be a 3-fold increase in just 7 years, and still only represent about 20% of the car market. Of course, it would be a disappointment to the investors that put their money on that 3x growth that EVs had seen just in the last 2 years, but would still be very strong growth, with much more on the way. But what of this current slowdown in electric vehicle growth and the pessimism around these stocks? I think it's largely due to 3 factors here, all 3 of which could start turning around next year and return EV to the market-favored growth theme. First, like most industries, the EV bloodshed is about interest rates. Higher rates mean a higher cost to borrow for consumers, putting the higher-priced EVs just out of reach. Here we see the finance rate on a consumer installment loans at commercial banks. For new autos, 48-month loans here, you can see it hovered right around 5% for much of from the pandemic all the way up to last year, but has just since jumped all the way up to 8.5%. Those higher interest rates, as we saw in the gory detail last year, have also hit the valuations on growth stocks. Using the discounted cash flow method of valuation, you discount a company's future cash flows to a present value using an interest rate. A higher interest rate just means that lower present value and a lower stock price for the company. The second factor here, but really related to that Fed's push for higher interest rates, has been its effect on the economy. With slower consumer spending and a threat of a recession, EV makers have responded with price cuts to vehicle prices. It's kept those sales growing, but has hit profitability and has driven most EV makers deeper into the red. Finally, electric vehicles have also lately become something of a political lightning rod, with some politicians drumming up support for votes by beating the drum against all things green. Now, while other alternative energy sources have always found themselves a target for politicians, EV has always seemed kind of apolitical in the past, maybe because Tesla was just so popular on both sides. But I think all three of these factors will start looking more positive the further we get into 2024. The Fed is expected to start cutting interest rates by June, and some expect as many as 6 cuts by the end of the year. Here we see the CME Group Fed Watch tool meeting probabilities, or the market expectations for probabilities of what the Fed is going to do at each meeting. And now we see here in blue is the highest percentage probability. We see the market expects the Fed to hold steady, not raise or lower cuts through these next 2 meetings here in December and January, but then to start cutting as early as March of next year. That's going to lower the cost of borrowing, boost stock valuations, and support the overall consumer and the economy. Getting past the November elections will likely put EV in the rearview mirror for a political flashpoint as well. Politicians are quick to pick a boogeyman when it comes to getting votes, but they're not going to want to alienate big money corporate donors after the election. So where does that leave EV stocks? I decided to revisit the valuations on some of the EV leaders, check out their valuations and the potential upside returns. First up, ChargePoint Holdings, ticker CHPT, will officially report its third quarter earnings this week after pre-announcing a couple of weeks ago that revenue would fall far short of expectations. The company also announced a surprise change in leadership, replacing both its CEO and CFO in a move that's really taken this stock to peak fear. Against that negative sentiment in the shares, the crashing price this year, the company is still a dominant leader with 43% of the market share for U.S. public charging. If we look at the valuations and the statistics here, shares trade for just 1.2 times sales, with revenue still expected to post strong double-digit growth for years. Now, charging is one of the big bottlenecks in EV adoption, and with the IRA program should bring a lot of funding sources to build that infrastructure. I added shares of this after the recent sell-off in ChargePoint, and it's now one of my largest positions. Albemarle Corporation, ticker ALB here, represents leadership in another bottleneck for EV adoption in lithium production. Now, even on scaled-back estimates for vehicle sales, we will be in a supply deficit in lithium that should reverse the price slump for the battery element. Miners, however, recently pulled back their expansion plans also due to that slump in prices. That's going to catch the industry off guard eventually when that demand jumps again. Here in the statistics, we can see shares now trade for just 1.5 times sales versus as much as 7x revenue just last year. We can see here in these price to sales, if you look at the current price to sales ratios for a lot of these EV stocks, they are just screaming bargains compared to the price to sales valuation investors were paying just a year ago even. Next, we have Chinese EV maker Boyd Company, ticker BYDDY. It passed Tesla as the world's largest EV car maker by unit sales this year with a total of 1.8 million when you're also including those plug-in hybrid EVs as well. This is Warren Buffett's favorite EV maker, with Berkshire portfolio holding nearly 8% of this company, though Buffett has trimmed his stake a little bit this year on those recent geopolitical worries. Another EV stock I own, Rivian Automotive, ticker RIVN, has rebounded 47% off this summer low, but still below the 2021 IPO price. Now, I started building a position here around $14 in March on the idea that the company could lead in that truck EV segment. The slowdown in demand has hit the shares, but the recent pullback in plans by Ford for its F-150 Lightning and just the high cost of Tesla's Cybertruck that they just started delivering could lead to a market position for Rivian. The company is still several years out from profitability and is probably the riskiest stock in this group here, but that upside potential could still be worth it. It's trading right now for a price to sales of about 4.5 times. It is a growth stock, still expected to grow sales strong double-digit growth each year. And you can see here in the past, trading for as much as 16.58 times on a price to sales basis. And of course, we can't talk about EV stocks without talking about Tesla. Ticker TSLA. It still dominates the theme with revenue of $90 billion expected this year, though that growth that investors have come to be expecting is slowing. Sales are expected just 9% higher this year before bumping back up to about a 20% pace next year. Even on that slowing growth, though, the stock still trades for about 9 times on a price-to-sales basis, with much of the hope for future growth. This is what Tesla investors need to understand, that a lot of this stock price current valuation is pinned on a robo-taxi service that they're expecting to roll out next year. Let's turn it over to some of the stocks I'm watching this week. First up, Stitch Fix, ticker SFIX. It's going to be reporting its earnings on Tuesday, with analysts expecting a loss of $25 45 cents a share. That would be narrowing from 50 cents reported last year. Retailers generally reported good earnings for the third quarter, and the Spider Retail ETF, that ticker XRT, is up 15% since mid-October. So that is a good sign for Stitch Fix, other apparel retailers that have yet to report their earnings. While revenue has been trending lower for the company, I continue to like this stock on just a turnaround play. The company has a strong balance sheet with $125 million in net cash. That's the amount of cash they have on the balance sheet even after if they paid off all their debt. $125 million in net cash. That is a big portion of the current market value of this stock. Cash flow positive with a unique AI model for online retail. C3.ai, ticker AI, is off this year's AI-driven surge by about 30% lower than that peak this year as it reports earnings on Wednesday with expectations for earnings loss to widen to 18 cents a share from a loss of just 11 cents a share last year. Revenue growth is expected to continue at about a 15% pace for this one, but the shares are going to need another binge in AI stocks to take it higher. Again, also watching ChargePoint Holdings here, ticker CHPT, it plunged 37% when it pre-announced its earnings on November 16th. So hopefully the bad news is already priced in here when it actually reports earnings on Wednesday. Investors are going to be looking for newly appointed CEO Jackson to explain that revenue weakness and how the company plans on recharging that growth. Pun intended there. Management has an opportunity to really boost investor sentiment and the shares if it can present a good case for the future. Showing you that bigger picture idea here with the sectorspiders.com sector tracker. Great way to see that bigger picture of the stocks in each sector. We did see 10 of the 11 stock sectors closed higher last week, with only communication services closing lower. Now, this was only because Meta, which was down 4% last week, and Alphabet down about 3.5%, together account for 47% of that sector weight, of that communication services sector. Now, that caused the group to close lower, while 12 of the 22 stocks in that sector did close higher. Energy continues to lag as uncertainty in that supply and demand weighs on crude prices, and the sector is now one of only 4 that are down for this year, down 2.8%, along with healthcare down 3%. We can look at this if we scroll out to the year to date. We can see that it's down 2.8%, healthcare down 3%, consumer staples down 4.8%, and utilities still lagging badly, down 9.9% for the year. Going back to the 1 month picture here, if you've been reading the newsletters or watching the videos here, you're probably tired of me saying real estate would be one of the best investments for 2024 as those rate cuts really reverse the pain that we've seen over the last year. That upside looks like it's already started, with the sector up 14% in the past month alone. That's the best returning sector so far over the past month, and now positive for the year. Shares of Medical Properties Trust, ticker MPW, are up 27% in the last 3 weeks, and Crown Castle, ticker CCI, are up 25% since I highlighted it in a video in mid-October. And we did see the best month in over 2 years for the market. The market has been exceptionally calm over the last 2 weeks as investors really digest that strong November rally and wait for data to confirm that the Fed is on hold for its meetings in December and January. If you are worried about stocks pulling back or giving back some of that recent gains, the VIX Volatility Index, that's the fear gauge on the market, has been touching multi-year lows lately, meaning that options prices are atypically cheap. Okay, options, call options, put options, always trade along with that volatility. With VIX, with the volatility index so low, with the volatility index so low, that means option prices are low. That makes it a good time to buy protection through maybe buying some put options on stocks or the overall index. You can buy put options on the SPY, the S&P 500 ETF, that index, to hedge those near-term downside risks in your portfolio. Check out that new fund on Arrived Homes or the opportunity to invest in single-family rental properties with the link I'll leave in the description below. Or check out these 7 top stocks with serious red flags. I guarantee you have one of these stocks in your portfolio and you need to see the red flags in these stocks. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.